Stocks moving higher in early action. We've also got yields under pressure after the Fed's preferred inflation gauge showed progress on inflation. So here to discuss what this all means for the market and what this means for the Fed moving forward, we want to bring in Marvin Loh. He's State Street's senior global macro strategist. Marvin, it's good to see you here. So we're looking at some relief maybe in the markets just in terms of what this could mean for the Fed. Do you think this print makes it more likely that the Fed might act sooner rather than later?
You know what? I think at the margins, it certainly confirms a view. If you believe that they might go in September rather than December, it's a possibility. But the number came in pretty much as expected. It continues to show the disinflation that the Fed is needing to see. But, there's still other components within the economy that it needs to get comfortable with before it pulls that trigger, if you will. But, certainly at the margin, if you thought September was a possibility, it gives you a little bit more comfort on that.
And so if September is a possibility here, one of the major things that we're trying to figure out is what employment or unemployment would tick to, and then ultimately as well, where inflation would continue on its own trend. What are your estimations by then?
Yeah, I mean, for sure. So, this was an encouraging number. Absolutely. One of the things that we look at when you kind of go through the details, if you will, is that these are year-over-year comparisons. So, if you had very low inflation numbers last year, in order for inflation to go down this year relative to last year, the number has to be as weak, if you will. So those base effects, in terms of how we look at things, become more challenging. So you could actually see inflation tick up over the course of the next couple of months before it stabilizes. And I think that's one of the challenges for the Fed, is that you're going to have this up and down kind of movement going into the fall. So it might not be as clear as what we're seeing today.
Do you think that even in that trend that markets could continue to notch new all-time highs?
Yeah, I think it is supportive. I think keeping the Fed in the story from a rate cutting perspective is powerful. We're coming into earnings season. Those numbers look pretty solid. And really looking at growth expectations around earnings for 2024 as a full year and 2025, it still shows that there's strength within the corporate earnings space.
Marvin, I want to switch gears a little bit and talk about what we saw last night from the presidential candidates, former President Trump and President Biden. And I bring this up because lots of talk this morning about whether or not Biden is going to continue in the race. And my question to you is how you're viewing this from a strategy perspective, how big of a risk maybe this potentially is, the uncertainty to the market.
Yeah, I mean, for sure, the performance of both candidates were interesting. I'll just leave it at that. Kind of looking at the odds market, if you will, another Trump presidency became a much larger possibility ultimately. And, how we look at things is that when those odds go up, you have to look at those policies that might come along with it. And really, whether or not we're talking about tariffs, whether or not we're talking about a much more lenient tax environment, you do wind up with inflationary pressures. So that is certainly one of the things that are in the back of our mind. Kind of having said that, a lot can happen between now and November, as well as real policy versus what some of these candidates might use when they're stumping around is often very different.
Marvin, given that, though, that there's so much uncertainty, is it likely to add to some of that volatility that we could see leading up to Election Day?
You know what? It's going to be isolated. I think the markets generally will look at a Trump presidency as more market friendly, less regulation, potentially less taxes. From that environment, it does provide support. But you're going to get nuance. You're going to get volatility in certain sectors that might benefit versus others. So yes, political risk is something that you need a premium for. And we're seeing that really play out in Europe as well as the other emerging markets as some of these surprises keep coming up on the political side of things.
One of the parties right now seems like it's 3 weekends away from Weekend at Bernie's. So all of these things considered, if we were to see a swap in or some type of new candidate emerge from the Democratic Party, what would that do for markets? What would the reaction be there?
I mean, you said that rather than I did, right? But we'll certainly parse the viability of that candidate. It does come down to 6 states. It comes down to how those candidates are divided. And really the calculus, if another candidate emerges, how successful can they be? Does it really change the concern that the Democrats have now, and really the way the markets are leaning more heavily, that the debate really assisted another Trump administration.
Marvin Loh, State Street Senior Global Macro Strategist. Marvin, thanks so much for taking the time here with us this morning.
Thank you.